Good afternoon, my name's James Gerrish. I'm a portfolio manager here at Shaw & Partners and also the primary contributor to Market Matters. And today I'm joined by Brett Mesurier, who is the banking analyst here at Shaw & Partners, and we're here, funnily enough, to talk all things banks. It's obviously been a very interesting time from a markets point of view. The banks have been at the forefront of all that. I guess we'll kick off and get your take on the banks post COVID-19. We've obviously seen updates from the majority of lenders. There's been some pretty significant provisioning taking place. How do you see the sector right here, right now?
Well, I have a buy on two of the big four banks, Commonwealth Bank and National Australia Bank. I've got buys on them because I think the market is being overly conservative when it thinks about what the future bad debt charges are going to be. The provisioning is probably fair, will probably last for a couple of years, and after that, credit quality should improve and bank share prices should increase significantly.
Just on the provisioning, so APRA were involved in the provisioning process or provided guidance. What's your take on government involvement in determining a bad debt charge, the provisioning that banks took on this time around?
Unfortunately, government interference has become a part of banking and started some time ago, and it's the Liberal government that's really brought it in. There wasn't too much interference when the Labor government was in power, but we had the bank levy that came in, which was the start of all things bad for banks. And obviously the pandemic is independent of the Liberal government, but the actions that have been taken by the regulator leading up to that have weakened the banks' positions in terms of the return on equity that they could provide. Effectively, the regulator has been pushing it down, which means when the bad debts go up and the share prices of the banks fall below book value and also in some cases below NTA, which makes capital raisings more problematic for them, because if you're raising capital below NTA, the dilution becomes magnified.
What about though the concept that because of what the regulators have done post GFC, the banks are holding unquestionably strong levels of capital. They're there to withstand periods like this. The regulator's done a good job by making them, I guess, safer institutions. I know it's hurt the shareholders, but from an overall safety perspective, hasn't it been a positive?
Well, the banks could operate quite successfully through the GFC, so you may question whether they're holding more capital than they really need to. The fact that the regulator has discouraged them from paying dividends during this period is an interesting development. I would have hoped that the regulator would have left them alone to manage their situation as they thought they were best able to do, which may or may not have resulted in them declaring a dividend at the interim, but obviously they've deferred it. Generally, interference by the regulators isn't all that helpful. In the case of our banks, what it's substantially done is, while pushed capital levels up, decreased returns, made equity more expensive for them, and I'm not sure that's the best approach for the regulators to have taken. But an increase in capital has been a good idea. The only question is, have they increased it too much? And I suspect they've probably gone too far.
Yeah, so if you think about the provisioning that got worked through in this recent reporting period, do you think they've over-provisioned? Given what we know now, government forecasting has proven to be too conservative, that the economic impact was going to be greater than it actually has turned out to be thus far. Have they provisioned too aggressively?
I hope the answer to that is yes. The provisioning that they put in place was actually very close to what I had expected before the results. I'd worked on provisioning and loss rates similar to the GFC. I thought, given the action that government was taking while the downturn was more widespread than the GFC, that government support was much stronger than it was during that period. Government support during COVID-19 is much stronger than it was then.
And quicker.
Yes, and so mitigated the effects much more significantly. So the losses that they're allowing for are similar to GFC levels, which is probably right. The issue is that the capital is twice as much as it was at at that time, which has led to the higher compression in share prices and the lower multiples on which they trade these days.
So if that's so they've taken provisioning, they've deferred dividend payments. Do you expect dividends to flow? How long do you think it will take for dividends to come back to normal? And is there a new normal? So is this an opportunity for banks to sort of rejig their payout ratios into the future?
The dividends, I don't expect an interim dividend to be paid by those who deferred them, being
Westpac,
ANZ and Westpac.
Sorry.
Yeah, NAB only
raised capital
dividend.
to pay a dividend.
So you're quite right with your suggestion. Perhaps they effectively didn't pay a dividend at all. Bank of Queensland deferred their dividend, although Bank of Queensland is slightly different to the major banks, of course. And I think beyond that, into next year, the bad debt charges may remain elevated. It depends on whether or not we get a second wave, how effective the liberalisation of the lockdown is in restoring the economy. I'm reasonably confident that when we get into the 22 financial year, the dividends will be back to a much more healthy level. And by that, I'm talking up to the mid $1, so around $1.50, give or take, for each of the September year-end banks. Now, whether that is similar to what you're suggesting on a dividend reset, it's not. They'll be setting their dividends based on what their ROEs are at that time. Now, what's also happening is that income growth is low and expense growth is continuing. Now, that increasing expense growth relative to income growth depresses returns, other things being equal, and lower ROEs for a given level of growth reduce payout ratios. But we may be looking at an ongoing low level of growth for the banks, not just on loans but also risk-weighted assets.
Just on expense growth, so they've obviously been through a pretty difficult couple of years on the back of a huge amount of regulatory impost. They're trying or working hard to simplify their business. Does the expense growth moderate in the future? Are expenses something that can be ripped out of banks going forward, and that's how they prop up their returns from here?
I don't think expenses will be ripped out. I think at best they will probably be stable. But if they can be stable and you do get some income growth, then you would get declining cost-to-income ratios and therefore increasing returns. That would be a good outcome. I suspect that's not going to be the outcome, that over the next year or two expenses will still increase faster than income for the sector.
And there'll be swings and roundabouts in there. CBA is doing a reasonable job on the income side. Other banks are doing less of a job on the income side.
Yes, well, particularly on home loans, the knock-on effects of COVID-19 mean that it takes them longer to process loans because they've got to deal with all the bad debts that are coming through, all the loan deferrals, trying to understand who should have a loan deferral and who should be tipped over the edge, basically. And that basically involves people, and the people that are going to be involved in that, unfortunately, will not be processing loan applications. So if you're going for a loan from a bank, you're going to have to be patient. And if you're in trouble, then the bank's going to have to be a little bit patient.
Okay, so the other headwind for banks is low interest rates. Obviously, low interest rates put some pressure on margins. What's your take? So obviously, the outcome of COVID-19 is likely to be lower rates for longer. Does that mean that NIMs are going to be pressured for an extended period of time, or are there some offsets that banks can take, or are you seeing any offsets that banks are taking?
Yes, well, over the last decade, interest rates have fallen significantly. Large retail banks, CBA and Westpac, their margins have barely changed. ANZ's has collapsed. NAB's is not quite so bad, but it's fallen materially as well.
ANZ's a bit of an anomaly given they tore up so much money in Asia though, isn't it?
They've done what they can to make the least of a bad situation. Sorry, distracted me. So what the banks do, the retail banks, there is capacity on the deposit side to reduce the average cost of deposits. And in fact...
pay less for term deposits, you're
Yes,
saying.
yes, but part of that is not just their action, it's the part of their customers, because what's the point of locking your money away? Or maybe a good point, it's hard to know what's going to happen with interest rates, but people are less inclined to lock their money away to get 1 or 2% and just in a TD, a term deposit. They're more likely at the moment to leave them in variable rate accounts, savings accounts, of which they have very little, even less than that. But at least they have the option, if interest rates do rise or they want to do something else with their money, it gives them flexibility and not much of a discount compared to what they would get.
And that's been supporting bank margins at this as interest rates have stayed low.
Yes, and in fact, over the last 6 to 12 months, the loan to deposit spread on Australian banking has increased, and that's offset the adverse impact of lower earnings on the NTA or capital that the banks have, such that margins have been reasonably stable.
So it's a challenging period for banks. There's no two ways about that. I get that you're reasonably not overly bullish the sector. You've been in the industry for a long time. You've been covering banks for a long time. What's your overall feel on banks at the moment? Are we at a low point? Does it get better? Does it bob along the bottom for a while? Are we a couple of years out before a strong recovery from the banking sector?
I think the recovery will come in the share prices, just because there's so many bad debts factored into them forever.
And we're forward-looking. I mean, the market is a forward-looking beast.
Yeah. So share prices will recover. So I think the September year-end banks will head back towards the mid-20s within the next couple of years, which would be a very
It's a strong return.
Very, very significant return. And Commonwealth Bank should be up above $80 again in that scenario. But that's about as good as it gets, because loan growth is likely to remain low, interest rates won't fall further, and it's falling interest rates that help spur loan growth, at least on the housing side. It can also help business as well. So loan growth is probably going to be lower for longer, therefore income growth will be lower for longer. So any additional re-rating from higher levels of growth from the banks is probably not going to happen for many years. So the boost in the share prices, which should come in the next year or two, would really be from a decline in bad debts rather than a much better operational performance. And by operational performance, I mean income growth.
So right now, the banks are at a low point in the cycle. They should improve over the next 12 to 24 months. And now's the time to be taking a more positive outlook on bank share prices.
Yes, but we should add the caveat that the next 6 months, are going to have ups and downs associated with it, and that it's not just one upward trajectory.
Absolutely.
You're going to have some anxious days as shareholders.
Absolutely. But if you think about banks are on as a sector 12.5 times the market's on 19, there's probably a case to make that banks are reasonably cheap, 30% cheaper than the market or thereabouts.
Well, yes, and you can also take a little bit further. If my forecast for FY22 are right, when the bad debt charges fall to around $1.2 to $1.5 billion for each of the major banks, that's a per annum number, then the PE multiples that they're on that basis are between 8 and 9 times.
Yeah, so Westpac just took a 1.6 billion provision, NAB 800 million. So there's, that puts those numbers in the context. Let's go down the tree a little bit into the regionals. Is there any, are regionals cheap enough, or is there just too many challenges for both Bank of Queensland and Bendigo at this point in time?
Well, if the theory is correct that the bad debt charges will reduce in the next couple of years, then those two banks would also benefit from it. Their challenges are more significant than the major banks, because they also have to improve their banking business, and by that I mean their operations. They haven't got it up to speed with the computer age as much as the major banks have.
Well, and within the major banks, there's, so you put CBA on one end of the spectrum and the other banks sort of on a quantum below that. And regional banks are one step
not
further.
close.
Yeah. So how do they do that? I mean, is that
It costs.
around? It costs, but
All that happens is they got to spend.
are they big enough to spend on their own, or is there scope for corporate activity amongst the regional banks? Will Suncorp's banking division merge with Bank of Queensland, or is there a role that's been to go?
It would be
in that
nice
mix?
It would be nice to think that the three of them got together in some form. It doesn't make a lot of sense for the three of them to exist independently. They each have to significantly improve their functions. As I mentioned, their computer literacy, the extent to which efficiencies through the computer age have not infected regional banks as it should have. So they have a lot of work to do, and when they spend, that hits their capital, dilutes earnings. So it's best that they just all get together.
So your view is
do it right, and do it for the three of them.
So your view is stay at the top of stay at the higher quality, more well capitalised bank in terms of CBA. Is that the number one pick in the space?
Yes, that's right. I always default to the best business, and that's unquestionably CBA.
Irrespective of valuation. So obviously CBA trades at a reasonable
that's
valuation premium to the others.
Yes.
It's warranted.
Yes, that's right. Absolutely warranted, given the fact that they've been able to grow their business while everyone else has struggled. They have the most efficient business. They're in the best capital position. If anyone's going to pay a dividend amongst the majors, there'll be CBA.
So stay with CBA, stay with the quality. Going probably the other end of the spectrum. So I know you've been negative on Virgin for quite some time. Obviously Virgin was used to be Clydesdale, spun out of NAB, is now merged with Virgin Money.
Yes.
And you've had a sell on it for a while. This bank tweaks my interest simply from a valuation perspective. It trades at 0.3 of book. It's had a huge amount of mud thrown at it. It's traded down from $4 to $1. It's now at sort of $1.80. Are you still negative on it? In a nutshell, I know you could talk about this for a while.
Yes.
Give me your 3 key points. Why?
Well, you have a few reasons to be cautious about this one. It goes to the asset quality and the provisioning of it. Heading into COVID-19, what they were doing was lending as quickly as they could in small business and unsecured personal credit. And that's exactly the areas that are going to be hit. The provisioning that they put up at the last result, I don't think was good enough. It was only a mild increase in unsecured lending when the rate of growth in loans had been significant. I think they should have gone harder. I don't know if the two things are related, but the bad debt charge and the statutory profit before tax were curiously close. I think they were £7 million different in about £230 million. Could have been a coincidence, probably was.
Absolutely.
You've also got the expenses side. They have two types of expenses. They have the real expenses, statutory expenses, and they have what they refer to as underlying expenses. The gap between them should be smaller than it actually is. It appears that these one-off expenses are growing. In other words, the underlying expenses is not really a reliable number. So the market thinking about an underlying profit number as the company discloses is probably overstating what the underlying profit is.
So there's a period of time you can skirt to underlying numbers, but if you continue to do it and then if you continue to see massive variance, then it becomes an issue, and that's what you're concerned about.
I am concerned about that, yeah.
So stay away from Virgin. So
I would. Yes, I would.
So it's a value trap. It's not a turnaround story. It's a value trap.
Yeah, you could be lucky, but I try not to be lucky. I try to understand what I'm doing.
So banks, the headwinds of banks are clearly there. Obviously, we've got an economic recovery to come out of post-COVID-19. Bank share prices will start to look through that and should have a positive 12 to 18 months, notwithstanding a challenging 6 months ahead. So, Brett, thank you very much for joining us, and I'll chat to you again soon.
It's my pleasure.